Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with John Jennings. How you doing today, John?
Hey, I'm doing great. Glad to be here.
Good. Well, glad to have you. So we brought you on the show. We wanted to mix it up a little bit this week and talk about some topics that we're getting a lot of requests about, which is the psychology of investing, as well as how the wealthy deal with this and compared to everybody else. So, John, why don't you tell us a little bit about your background?
Yeah, sure. So I actually started my career as an estate planning and tax lawyer. I also did some speeding tickets, which I currently do. I'm in St. Louis, Missouri, and I will tell you, Missouri is a speeder's paradise. But I did estate planning and tax law. And I was at Arthur Andersen. And I find that for younger people, I have to explain what Arthur Andersen is. But it was a big five accounting firm. Now there's only a big four. So it went under in the wake of the Enron scandal. It was the auditor for Enron. So kind of went down in the middle of that. And, it's kind of interesting at the time. I was like, oh, this is horrible. And in so many respects it is. And it was tragic, great firm, I think treated unfairly. But what it did is it really was the impetus, for us starting this current firm, which we did 21 years ago. So my firm is St. Louis Trust and Family Office. So we are a multifamily office. We work with 63 client families. Most are not in St. Louis, and about $15 billion of wealth. So it's about 200 something million a piece. And we're mainly in the $50 to $500 million range. So we have 61 employees, 63 client families. So do all sorts of, investment management, but, pay bills, estate planning, manage the estate planning entities, on and on and on and on. So that's what we do. And personally, I teach at Washington University also, in addition to working at St. Louis Trust and Family Office as president. So I teach 2 courses at Washington University in their business school. I write for Forbes, and I've recently written a book. So there's me.
Cool. So what got you started in in the ultra high net worth space?
Yeah, it's more happenstance than anything. I mean, we at Arthur Andersen, we had a registered investment advisory practice that I was part of, in addition to doing, tax returns, but then what later became known as tax shelters, which were a lot of fun to do. But when Andersen imploded, I mean, we had kind of worked with executives in corporations and, some families. But when Andersen imploded, what we decided to do when we started our new company is, kind of being aware of the 80-20 rule, which is a type of power law. We realized that 20% of our customers, our clients, generated really 80% of our revenue. So when we started our new company, we only invited that 20%, or more like the 10%, to come with us. So we intentionally started with, let's do the super high net worth or the ultra high net worth families, instead of working with the more, the more what I'll call mass affluent. So it was somewhat happenstance, just with what happened with Andersen, and just noticing that 80-20 rule.
So you mentioned tax shelters. You don't hear a lot about tax shelters nowadays.
No.
Do those still exist? Can people still hide money in Swiss bank accounts? What do you mean by tax shelters?
Yeah, so by tax shelters, so there were regulations that came out and labeled certain things as tax shelters. And I can't give you the exact year, but it was around the millennium, the turn of the century, into the 21st century. And really, if you have something that's been labeled a tax shelter, you have to report it. So it really shut down a bunch of planning techniques. And I'll tell you, when I was at Andersen, some of the things that we did, and there was this period of time, it wasn't just Arthur Andersen doing it. So all the big and medium-sized accounting firms and law firms and were doing it. But there would be situations where if somebody was selling their company, and let's say they were going to have $100 million of gain, there were things that we could do that would generate $100 million offsetting loss without having the economics of actually having a loss. And at the very essence, I think of what I would refer to as a tax shelter is something that you do that follows the letter, but not the spirit of the tax law. So, I used to do I loved it. I did a lot of research into helping our firm come up with these really creative strategies that would have these amazing tax benefits, but really, when you looked at them, you'd go, okay, this is not what was intended. you're threading a needle here that they didn't intend to exist. So many of those have been shut down, and I think it brings up a great kind of point. So people generally think that if you're super wealthy, that you can really avoid paying, income taxes. And in my experience, that's not been the case, especially since so many tax shelters have been shut down. And it may be that incredibly wealthy people, people with hundreds of millions of dollars might pay a lower tax rate, but that's just because investment income, whether it's qualified dividends or long-term capital gains, are taxed at a preferential rate. So it could be that they're paying like a lower rate, but I'll tell you, my clients, with rare exception, pay a lot of money in income taxes. And it's really difficult unless you own a bunch of real estate, and then it's just a timing thing. It's really difficult to get to the point where you're paying little or no taxes when you're wealthy in America.
Well, it's interesting because, if you look at companies, some of the big tech companies, they pay like single digit tax rates.
Yeah.
And they're some of the largest revenue producers in the world, and they're paying almost no tax.
Absolutely.
Which is certainly one thing which I'm curious about. And the second is, but don't wealthy people just own a bunch of muni bonds? I mean, those are tax free.
Yeah.
And then you have the real estate. I mean, those are like the big two. So what else is there that people use to kind of hide from paying tax?
Yeah. The big ones absolutely are. So when we invest our clients in bonds, we mainly do muni bonds. So they're tax free at the federal level. So absolutely. Other things you can do is you can use life insurance in creative ways. We don't do a lot of this because it tends to get bogged down in, complexity and et cetera. But, there's types of life insurance policies where you basically are paying for the life insurance wrapper, which of course, life insurance allows you to have tax-free, run up in value of the cash value. And then, the payout at the death of the insured's income tax free. So you can put investments inside a life insurance policy. That's a big thing. There are some things you can do with retirement accounts. I mean, remember, Mitt Romney had, a huge amount, tens or hundreds of millions of dollars in his IRA because he had put, he was a partner at Bain Capital, which is a private equity firm, among other things, and had put what's known as his carried interest into his IRA. So, that's a creative thing that sometimes can be done. You mentioned real estate or, businesses. If you have the ability to take depreciation or operating losses, definitely, real estate's a way that you can shelter your real estate income. Now, realize, if you're a passive investor in real estate, you can't offset your other investment income other than real estate, and you can't offset your wages, but you can definitely shelter your real estate income with depreciation. But at some point, you're going to pay the piper on that. I mean, but when you take depreciation, it reduces your basis, so you'll have a bigger gain later. But you can, you just continue to, throw that ball downfield for as long as you can, right? So that gets done a lot in real estate. So those are really the big things, other than just being smart about the tax efficiency of what you invest in. So that's really the main things that people do. I don't see any, big silver bullets out there that I think are legitimate. I mean, people are always coming up with some things that have the risk of being labeled as tax shelters, and we come across these, and again, if they meet the letter of the law but not the spirit of the law, our advice to clients is typically, you're already rich, you've already won. Do you really want to, go down the path of something that just, really doesn't feel right?
Yeah, so you mentioned a few things. I'm curious. So the Mitt Romney, at the time of the research when he was running for president, was $102 million IRA. Now, we actually specialize in self-directed IRAs. So the thing always puzzled me is, why would a man who could pretty much do whatever put that money in a traditional IRA, which he's going to be paying tax on that as income at a later date, which is going to be higher than if he just kept it as carried interest? Why not put it in a Roth, first of all?
Right.
And second of all, I think somebody analyzed it and said the tax benefits actually would be better if he kept it outside.
Yeah.
Right. So
because
to me, it was
because
just
of
a big
the
puzzle.
preferential taxation on carried interest. Absolutely. And I now that you mentioned that, I remember thinking that at the time, going, why wouldn't he do this in a Roth? I hadn't thought about the fact that probably even be cheaper, to pay the tax earlier rather than later at a lower rate than a traditional IRA. Absolutely. Yeah.
Yeah. So that always puzzled me. I was just
Yeah.
curious your thoughts. But so I guess so two things. You hear a lot about people like Warren Buffett or Elon Musk or other people like that, and they kind of follow a grow and borrow approach, which is they don't really take out they don't get paid income. They basically, they have stock and they grow the stock price and then they borrow off of it.
Yeah.
And so I'm wondering, like, is that a strategy people use, like, that you've dealt with?
Yeah, a bit, but I'll tell you, our families fall into really one to two or three camps that we work with. The majority of them have exited a business. So they either owned a family business or a closely held business and they exited, or they were typically CEO, sometimes other C-suite at a publicly traded company, and then they retired or they're close to retiring, so they've cashed out. So those are the first two flavors. The third flavor of family we work with currently own businesses, and those are typically S corporations or LLCs. I mean, if they're closely held, they typically want that one level of taxation, so they're pass through, so they're going to be taxed on the income of the corporation or the LLC, regardless of whether they take distributions. I mean, the distributions generally are non-taxable. So that idea of you don't pay yourself and you take loans against it would work with a C corporation. So that's a corporation that is a taxpayer. It's not a pass through. But in that situation, you're paying a corporate level tax. I mean, I don't deal much with corporate tax, but I think it's 21%. So it's not a high rate of tax, but it is potentially a second level of tax if you were to take a distribution. But yeah, if you have a closely held C corporation, there may be ways that instead of taking distributions, you take loans and you pay that one level of tax like you would with an S corporation. But if you think about Berkshire Hathaway or Tesla or SpaceX or any of those things, they need to be C corporations because of their number of basically shareholders and the amazing complexity and difficulty of, if you imagine Berkshire Hathaway or Tesla as an LLC, I mean, first of all, it couldn't be publicly traded. And then, just with that many shareholders, it would be, really, really hard. And there's, SEC limitations on, if you're, on how many slots you can have. So really they need to be C Corp. So it's good planning for a C Corp owner, but most family businesses aren't C Corps.
So how do companies like Apple or Google or Meta or any of these companies, how are they paying like single digit tax rates? Like how is, because to me, like, why not just put all your money in a corporation, just pay like 1% tax rates? Like why do these companies get away with getting that low of a rate?
Yeah, so I can't tell you the details on how these companies structure that. I'm not really a corporate tax guy, nor have I studied the issue on how they do it. I know, like, for Amazon, for a long time they just had more expenses than they did even their massive revenue, because they were reinvesting and investing things in, like, AWS and all those things. So I think these corporations are obviously doing things to structure their revenues versus expenses that way. And there are some things that corporations can do, research and development tax credits, and these consulting firms and accounting firms sell R&D tax credit studies. And then there's the depreciation they have on real assets and, all sorts of things that they do. But I can't give you details on that.
Okay. I was just curious. It seems to be something that's in the news a lot. And it looks like, oddly enough, just looking up here an article, it looks like came out yesterday that tech companies get access to our tax data, which is interesting. I just saw that just now.
Yeah. Wow.
Not surprising, but still sad. So all right, so let's kind of dig in here. So we talked a little bit about before the show that one of the challenges that people face is certainly kind of like the psychology of money or investing. Yeah. So let's talk about some mental models, because I think this is instructive for people to really hear how people think and how they should think about investing in money in general. So what are some kind of, I guess, financial mental models that people should be aware of?
Yeah, so let me, probably most listeners are familiar with the concept of mental models. I mean, it's something that was championed by or pioneered, maybe even the concept created by Charlie Munger back in, he talked about it in a 1994 speech to USC. But really just to explain what that is. So a mental model is just simply a model of how the world works that you keep in your head. And the idea is that you study a bunch of different areas and that you learn them and then you file them away. And really what Charlie Munger says is you can't just bang back just facts. You need to have a lattice work. They have to hang, they have to hang together. And he talks about a lot of different mental models with respect to making good decisions in life, being what he calls a world-wise person or in business. And really what I've done with my book, which is called The Uncertainty Solution, and the solution is to dealing with uncertainty, is to have a lattice work of investment mental models and to know which ones to pull out, at what period of time. And I go through 35 of them over, 10 different chapters. And really, I'd say the first mental model to understand is not even an investment one. And it's that we as a species, humans, have evolved to dislike uncertainty and to crave certainty. So if you think about it, from an evolutionary standpoint, if you were an early human, say living 100 or 200,000 years ago in a small tribe of hunter-gatherers, your ability to spot patterns actually allows you to see into the future and to have a survival advantage compared to those that weren't as good as predicting patterns. So the ability to spot, weather patterns, seasons, migration pattern of prey, are those berries or mushrooms poisonous or nutritious, all those things helps with your survival. So people that were humans, early humans that were better at spotting patterns, survived longer, reproduced, and we are now their descendants, right? So we are pattern recognizing machines, basically now as modern humans. So what that means though is when we can't see a pattern the way we've evolved, we don't like it. So it makes us antsy or anxious or worried, or sometimes it even triggers our fight or flight response. So we don't like uncertainty in general. And then once we resolve it, we calm down, we relax, or we actually get a hit of dopamine, which makes us feel good. It's like a hormone that creates pleasure. So we actually feel great when certainty, when we experience it, when we resolve uncertainty. And if you think about it, this sort of makes sense. Like we like a little bit of uncertainty that's non-threatening. So, if you're a sports fan, you don't want to know the end of the game. Like if you're recording it at home, you're like, I'm not checking my social media. I don't want to know who won, or, you don't want to know the end of the movie or a novel. And some people like to gamble because it creates non-threatening uncertainty. And then, with the spin of the wheel or the pull of the slot machine, and, now whether or not you've won. So it's this complex relationship that we have with uncertainty. But the thing to take away, the mental model around uncertainty, the main one, is that our desire to resolve uncertainty is what's known as a primary human motive. So that means it underpins so much of our behavior and so much of our decision making. And just start noticing when you feel uncertain and how, because we feel anxious and worried, emotion starts kicking in. We may not act completely rational. I list out in my book some things that we usually do when we're feeling uncertain. And the key is not to do those things that we usually do, because what we usually do is based on, hundreds or millions of years of evolution, yet we live in these modern times where we're rarely actually under physical threat. So I would say that is the first and important thing to understand, I think, about why we dislike uncertainty.
Yeah, it's interesting because I know Tony Robbins has a thing that he talks about, like the 6 human needs, and one of them is certainty. And then you have the opposite, which is uncertainty, right? Variety. Right. And, we need certainty, but we also need variety and certainty in our lives. And people have different degrees to which that affects them. And like you said, gambling is a need for uncertainty versus somebody who may not be addicted to gambling. They don't need that uncertainty.
Right.
So it's interesting. It's an interesting perspective.
Well, and all of us vary in how well we deal with uncertainty, and it can be different by different areas. There's actually online, assessments you can take to see how well you deal with uncertainty or ambiguity. And really, uncertainty is at its root definition is our inability to spot a pattern. And so then partly what we do is we want the world to make sense, and we want explanations. So we often see patterns where there aren't actually patterns, and we ascribe causation or explanations to things that are really just more randomness and noise, right? In fact, I have an entire chapter called on correlation and causation. And again, that the fact that I said that may not make people want to run out and buy the book, but I think really there's a lot of different stories and mental models around causation and correlation. And I'll give you one. This is one that people tend to enjoy, and it sort of sticks with them. Is I was at this investment conference, I don't know, 5 or 6 years ago, and I was at the cocktail hour afterwards, and of course I'm like sipping the cheap conference wine, and I end up talking to this woman that's the CEO of an investment firm. And I said to her, I said, what does your firm do? And she said, oh, well, it's simple. We invest only in companies, public stock of companies that have strong female leadership, either female, CEO, strong, female representation on the board. And that's because female-led firms outperform male-led ones. And I was like, wow, that is amazing. Like, it was so simple. And my mind jumped to all the reasons why a female-led firm might be better. In fact, our firm is female-led. I'm president, but our CEO is female. Half our management team is female. We have bunch of females on the board. We're 65, 70% female overall in our firm. So, I like this idea a lot. So I came back from this conference, I started researching it, and there were studies showing that if you look at the S&P 500, like the 80 of the 500 or whatever it is that have female leaders over the time period looked at, they had outperformed the S&P 500 handily. And there's all these particular possible reasons. I mean, females in general are more risk adverse, or maybe they're not making as many errors. 70% of purchasing decision in American households are made by the women, and so maybe by being female leaders in a firm, they're more in tune with who their end consumer is going to be. And maybe because the glass ceiling and all the issues of being successful in business as a woman, if you've made it to the C-suite or the board of directors, you're a rock star. So you're just a better leader than maybe your male counterparts are on average. So there's all these great reasons. And so based on this, I thought, wow, maybe we should invest in either this firm or another firm, or even an index. There's indexes that track, female-led companies. Well, like the next week, I went to a client meeting, and one of my clients, who's one of the smartest people I know, he used to be chairman and CEO of a Fortune 100 company. I told him about this, and he said, are you sure the female leadership is causing the outperformance, or is there something else? Is there like maybe a common cause, or is it a symptom? And if it was anybody else, I would be like, oh, no, I've researched this. But because he's so erudite, I went back and did something very hard, is I went and researched against what I thought, right? And I found that there was research that suggested the opposite, including a female PhD researcher from Northwestern, and different psychologists that said that there isn't conclusive evidence that female leadership causes the firms to outperform. There's actually some possible evidence that once a firm is already strong and outperforming, that then they have the capability and the almost luxury to focus on things like diversity. And so that maybe having a female leader is a symptom of a high-performing firm, and maybe it's not a cause. Now, the jury's out on this. There needs to be what's called longitudinal studies on it. There's only been observational studies, not longitudinal studies. So I'm not saying that female leadership doesn't cause outperformance. My point is that I had, along with a bunch of other people, jumped to the conclusion that we saw a correlation and said one thing causes the other, when that may not be the case. And so the fact that correlation doesn't always mean causation, or to dig more into it, is something that's really hard, because we have evolved. We're hardwired to jump to the conclusion that something causes something else, because we want to see a pattern that we can use to help, aid our survival. Right. So anyway, Another mental model for you.
It's interesting because I was listening to a podcast and somebody was saying is how our brains actually work is we make a decision first and we come up with a justification after, even though we think we have the data, and then we're making the decision. It's actually the opposite. We make the decision, we're like, all right, now we're going to justify it in our head and come up with all this stuff. So it's funny you said that, because it was a really great blog post that a lot of people have repeated by now, but talks, and I have it actually on my website. There's correlation versus causation, which you can compare the divorce rate in Maine to the per capita consumption of margarine in the US, and it's like a 99.26% correlation.
Yeah.
Well, I don't know if there's causation there, but it's really correlated.
Yeah.
And so to me, I love this stuff about women, because it kind of just makes you think. It's like, is that true or not? Like, I don't know. Right. It's so I love that example. That's probably one of my favorites, because it happens all the time.
All the time.
And it's especially the more data that backs it up and supports it, the more you're likely to believe it. Yeah. So I remember having a conversation with a friend of mine about risk management, and he was saying, well, why don't you just buy this ETF, which basically all they were doing was just taking advantage of the VIX spiking. So it's like, oh, how do you manage? It's really volatility, not risk, but how do you manage the volatility risk? And it's like, oh, well, it's spiking, so the VIX should naturally spike, and that should offset it. Well, then the very next week, the markets went down like 10% and the VIX didn't move. I was like, okay, all right. Apparently this doesn't work all the time. But it was a great example of like people just thinking naturally it's going to happen in a certain way, and it doesn't always happen that way. So so I think that's great. So so give me another one. This is great. I love going through all this stuff.
Well, I'll give you what is I think probably the most useful investment mental model in my book, and that is that the stock market is not the economy, and we all know this, especially if we're in the investment world. But to really put some data and examples around it. So what this means is if you look at economic growth, for instance, so is represented by GDP, and you look at annual GDP growth, and you look at the annual return of the S&P 500, there is zero correlation between the movements in the stock market on an annual basis, calendar year basis, and GDP growth. So in fact, since World War II, it's a 0.03. So that's basically zero. And as listeners may know, when something is uncorrelated or a zero correlation, it means when one variable moves with respect to its mean, it doesn't tell you how the other will move with respect to its mean at all. They may move together, they may move opposite, they may, one may move, the other may not move at all. So it means that there's no information you can gather from one to tell you about the other. And in fact, if you go back to 1930, there were 19 calendar years where GDP was negative. GDP growth was negative. And in 12 of those 19 years, the S&P 500 was up. And in all but 1 year, over 18%. So imagine that you have a year in which the economy is contracting so much that it's actually negative for the calendar year, and the S&P is usually up over 18%. But what's interesting is Credit Suisse, which unfortunately doesn't exist anymore, subsumed by UBS, but Credit Suisse years ago looked at this, and they did something interesting. They said, if you look at prior year stock market returns, and then the following year GDP, the correlation jumps to like a 0.6. So what that tells you is, and again, it's not perfect, but what that tells you is if the stock market is going up the prior year, then in general, usually the economy is going to be going up the next year, and vice versa. So what it tells you is the stock market predicts the economy-ish, like not perfectly. You wouldn't want to make a huge bet on the economy based on a 0.6 correlation, but it tells you ish that the stock market predicts the economy, but the economy doesn't predict the stock market. And if you were, as an investor, you'd prefer the latter. You'd prefer the economy to tell you what the stock market's going to do, because in general, we right now, I just saw today, a news headline that I think was from a report yesterday that, Goldman Sachs is now unclear about whether we're going to head into recession. A few quarters ago, everybody's like, oh, we're heading into recession. Now everybody's like, maybe we're going to have a soft landing, right? So who knows? So we're not great at predicting the economy, But what this tells you though is when you look at the economy and the real world in news, it tells you that current news and economic indicators aren't going to tell you what the stock market's going to do, because the stock market moves in advance up and down, but not perfectly, of what the economy is doing. And a perfect example was back during COVID in March of 2020. So thinking back to then, the market high before COVID really became this huge issue in the U.S. was February 26th of 2020, and over the next month, the S&P declined about 34%. So it was the quickest decline in the history of the S&P, even going back to 1929. But the market bottom was on March 23rd. And so what was happening on March 23rd? So let's imagine, Kirk, that like you and I are sitting around on March 23rd, and we have a crystal ball that will tell us what's going to happen in the world, but not the stock market, right? And what we see is, we've just had our 1,000th reported COVID deaths in the U.S. We're going to have over 300,000 by the end of the year in the U.S. We're going to have over 6 million over the next 3 years worldwide. Second quarter GDP is going to drop by almost 9%. Stunning. Unemployment is going to spike to 14.7% here in a few weeks. Huge parts of the economy are going to shut down. We can't travel internationally. NHL, NBA are going to cancel their seasons. On and on and on and on. Like, I think we and most people, without knowing this mental model, would be like, oh, we should move to cash or gold, right? Or whatever. But that was the bottom. And the S&P rebounded by 70% through the end of the year. And we saw that in 08, 09. We've seen this over and over again, where the stock market acts or turns way in advance of what the economy is doing. And as an investor, you may say, oh, well, that sucks. Like, that gives me more uncertainty. And I'd love to be able to look at an economic indicator or the news to tell me I'm going to invest. But actually, it should be freeing, because what it tells you is you don't have to be able to predict the future of what's going to happen. Because even if you could, it wouldn't tell you what the stock market's going to do. So you can just not worry so much about knowing every piece of news that's out there. You don't have to read the Wall Street Journal every day and watch CNBC for hours. You don't have to, get all these investment newsletters and hear what everybody's predicting, because they don't know. And even if they did know, it wouldn't tell you what the stock market's going to do. So
yeah, no, that's I love that I love the way you kind of describe this, because I mean, the stock market generally predicts like 6 months in advance, right? So it's discounting what 6 months in advance looks like, which of course nobody knows. You can't even predict tomorrow, nonetheless 6 months from now. So that's great. So let's
go kind of like the wisdom of crowds. You've heard about those studies where if you ask a single person, what's the weight of that, that bull over there, it's going to be way off. But if you get 1,000 people guessing, they'll get within like a few pounds when you take the average of everybody, right? And so that's a bit what's happening in the stock market. It's not that any one person is out there saying, in the stock market saying, here's what's going to happen, but it's the wisdom of crowds, as you have all these people that are massively wrong and a little bit wrong, all averaged together with an ish is predicting what's going to happen.
Yeah. Okay, cool. Well, let's dive in one more, and then we can talk about some other areas too. So what's another mental model that you think is really
so let's jump to
important?
like, what does good investment behavior look like? And in my book I have a list of these, and really the culmination of the book is what should you do as an investor, not exactly how should you invest, but what does good investment behavior look like, and how should you think about investing? And I think a really important one is to have it as a default of inactivity. And there's a few studies that really shed some light on this. And my favorite one is called Boys Will Be Boys. And then the secondary title is something like, study of gender differences in investing. And these professors, these academics, somehow got a discount brokerage, which is unnamed, to give them 10 years of data on 35,000 brokerage accounts. And so they dug into the characteristics of the returns and why the returns happen, but then what were the genders of the people making the decisions on the accounts. And what they found is the highest performing accounts belonged to single females, followed by married females, followed by married males, with single males bringing up the rear. And they said, well, why is that the case? Why did single females outperform? And what they found is that both genders, regardless of marital status, were about as equally as bad at making investment decisions. So what they found is that on average, whatever people sold outperformed whatever they bought. So on average, every single investment decision was a loser. So that would suggest that the more you trade, the worse you do, which is what they found. So they found the single females traded 45% less than the single males. And their conclusion of why that happened, they speculated, is that it's because the males were more overconfident about their abilities to make investment decisions and what they thought was going on in the market and the economy and everything. And this was based on a host of other studies that they didn't do, showing that males are more overconfident when it comes to financial and investment things. Now, females have their own areas where they're more overconfident than males, just not in finance and investment. And so because of their overconfidence, they traded more. And you may have heard reported there, then Fidelity did an internal study that they didn't release the study, but it was reported on, where they looked at 10 years of data on, what are our highest performing accounts. And they found it was of dead people in locked accounts. So people that, switched jobs and had changed their 401k and things like that. So it kind of goes like this: dead people, female, then male. So as I say in my book, if you're male, try to invest like a female. If you're female, invest like you're dead. And then there was a study that was published in the Journal of Investments from 2008 that looked at years of pension plan sponsors. So again, these are professional investors. They have, committees, they have dedicated staff, they often have consultants, investing billions of dollars. And they found the same thing as the Boys Will Be Boys study did, not on gender, but on investment decisions, that they found on average, when these pension funds changed investments, that whatever they bought underperformed whatever they sold. So it happens not just to retail investors, but professional investors as well. And, we see this with our clients. I see this with myself personally.
So I actually want to point this out. So the Fidelity study talked about dead people. They've never confirmed that. Like,
I agree.
Fidelity has this knack of putting things out there somehow, and then they never confirm it. Like when never confirmed it. Like when I started at Payne Weber, I was sitting in a room with a Fidelity wholesaler who basically said, we did a study back decades, and we looked at the Fidelity Magellan Fund and said, and I forget the stat. It was something like, people who traded in and out did a lot worse than if they just held. And there was like another study that I forget what the nature of the study is off the top of my head, but there was some study they did, and they said, here's the data, and I can't find it anywhere. Like, I've actually reached out and said, hey, do you have the study? Like, no, that doesn't exist. I'm pretty sure it exists because you told me in a sales meeting, like, no, that doesn't exist. It's like, what is
I'll
going
tell you that
on? Fidelity,
that internal Fidelity study, I've looked everywhere, and all I can find is, there was this, and I forget the name of the publication, but there's reporters talk to somebody at Fidelity who discussed their internal study. Yeah. So all we have is reporters reporting on it. And there are some people that say, well, Fidelity hasn't confirmed it, we can't find it, so it's not real, which I point this out in a footnote in my book, but it is consistent with the idea that the less you trade, the better you do. And there's a whole host of other studies on that. Well, and I absolutely believe that the Fidelity, saying that the people in the Magellan Fund that just held it a lot better than traded in and out. Like, absolutely.
Yeah, no, I totally agree. Yeah, it's just like anything else you see in the news. You can't trust any of it. It's like,
but it's really
makes sense.
Hard. It's really hard to be inactive. It's incredibly hard, because you'll see maybe some of your investments, even if you're index, like if you have a small cap index, it's trailed the S&P 500, which is large cap, for a long time now. And it's tempting to say, okay, well, I'm going to sell the small cap and buy something else. And you got to realize that probably it's the wrong decision.
Right. Well, it's like value stocks have underperformed for the last 20 years. And yet people are still investing in value. There's nothing wrong with value, but it's compared to the 5, or the FANG M stocks or whatever they're called now. Like,
I think they're called the Magnificent Seven is the most recent I've heard. Because now you got like NVIDIA in there, and
oh god, yeah, that's driving the performance this year of the whole index. So All right. Well, I think, I love these. These are great. Let's talk a little bit about, the psychology of wealthy families and how that differs from everybody else. Because I think, there's a lot of instructive lessons in there that I think as people go through, I don't want to say extreme cases, but if you sell your company at 40, you really have nothing to do with the rest of your life. You're effectively retired, but you're retired at 40. So, people are put in these situations where they have to figure things out. So what are some of these examples when you're dealing with, large family relationships, like from a psychological standpoint? Like, what are some things that people encounter?
Yeah, so it's interesting. We tend to want to have more money rather than less, and that makes a lot of sense on a whole host of different levels, right? And I'll tell you that what the research shows, and by the way, my next book is on these sort of topics. So I've done over the years a lot of research on these topics. But what the research shows is, there was a study that got a lot of press, 5 or 8 years ago that said that, at the time it's been adjusted upward because of inflation. But if you once you make 75 grand a year, more money doesn't add to more happiness or a sense of well-being. And there's been other studies that say that's absolutely not true. And in fact, one of the studies that's not true got with the people that came up with the $75,000 study. And just in March, they published a paper together trying to square that circle. And so they went into, there's some details or whatever, but in general, people that do have more money, even past, 75 or 90 grand or 200 grand, do have a higher sense of well-being and happiness. It's not, just, it might be just a little bit, but it does continue on. And that sort of makes sense. Like the more money you have, you do feel more, in general, financial security. You take better trips. You eat at better restaurants. You drink better wine. You have better healthcare. You tend to live longer, and all those things. But it's not this major effect. There is this tapering off that occurs. And once you start getting, what I've observed is once you start getting to higher and higher levels of wealth, it actually starts creating some problems that may more than offset some of these other senses of well-being. And I'll tell you, among our client families, if you ask them what are their concerns, all of them would say in their top three, and most would put as number one, I don't want to ruin my kids or grandkids or great grandkids or whatever. And this is this huge concern because they see sometimes how wealth can be destructive in families or to individuals. And your exact point, I've worked with, we have clients that have sold their businesses at 35 and 40 and 45. And in fact, I met with someone who isn't a client, but he had sold his business for $750 million, and he was 46 years old. I met with him about 2 years ago, and he lived in this just amazing house on the ocean and had, a home in the mountains and traveled and whatever. He had sold his business about a year before. And he's like, there's only so many quail I can kill and rounds of golf I can play. And I'm completely lost. I'm totally at sea. And, we each need to have an idea of some purpose in our lives. And purpose isn't one overarching thing where you say, oh, this is my one thing. That's a very Western view that is flawed. Our purpose is typically something that we mine, we actually create, and it can be a bunch of little things. And I think people don't pay enough attention to that. The Japanese call it ikigai, ikigai. It's this conglomeration of things like what gets you up in the morning, and I think focusing on those sort of things, I think is incredibly important. And what we tell our clients when they have a big exit is if you don't already have a therapist, you should have one. Absolutely. Talking about these big things about life purpose and meaning and you'll feel great for a little while. And then there's going to be this effect where, you feel rudderless, and we see it over and over, and it can be difficult. And then you have this big worry about, stewarding the wealth is going to ruin my kids. There's a lot of concern about other people knowing about it. So we work with a family that lives in a relatively small town. It's like 100,000 people. and they sold their business, I don't know, like 5 years ago, and it was to a public company. So the amount was in the paper, and it was like $847 million or something like that. I mean, it's not that exact number, but something, some huge amount. And a year later, one of the family members said she's like, the past year has been maybe the toughest year we have had as a couple, because everybody knew that we owned a company and that we were, relatively successful. But once they knew that number, everyone treated us differently.
Yeah.
And she's like, at church, at, our relationships with people, and then we have other people that start treating us in ways that we think it's just because we're wealthy. We don't know who is really a friend now. She's like, it's just been horrendous. So yeah, it's not all puppies and butterflies, right? And which is why you asked the question.
Yeah, no, I ask it because I think, we have this perception that the ultra wealthy have no problems and everything's easy. And, oh, wouldn't it be nice to be wealthy? I mean, you've got a whole generation of people that are following influencers because they're pretty and they're successful and they're wealthy. It's not necessarily the case, but that's the the image put out there. And so, we think about these people like, oh, they must have it easy because they've got money.
Yeah.
But I know that's not the truth, but I guess it kind of comes back to, somebody selling their company is kind of like you're retiring. You have similar challenges, right?
Yeah. Yeah. And a great book on this topic, it was published, I don't know, probably about 10 years ago, is What Happens When You Get What You Want? What happens when you get what you want? And it's this great book by this psychologist that's dealt with a lot of people in this situation. And I'll tell you, he doesn't have any answer. And, there's no one answer here, because I think everybody struggles at some point with purpose and meaning. And I felt it too. Like when I wrote my book, it was this 15-month long, just really frustrating, really challenging, really fun and fulfilling and horrible experience, right? And when I was done, I had a few months of almost being depressed, because I had achieved this big hairy goal of writing a book that I was proud of, and I knew it was going to happen, and it still happened. And then you got to say, okay, how do I turn the page and do something else? And and sometimes what you want, and it can affect other things. Like when I finished my book, and when I was writing my book, I used to be super excited to write articles for Forbes, and now it feels more like not as fun, because like writing the book was so challenging and fun that just merely writing articles isn't as fulfilling, right? So it's like, oh my gosh, now I'm done writing the book, and this other thing that I loved, I don't love as much. And I see this all the time with our clients, that exit their business, like their business was their baby, it was their part of their identity, and it was this challenge. And then when it's gone, you just have this big bag of cash, and it's like, now you can't recreate that. What else can I do? And it's hard, and it takes years, and if ever, to recreate that sense of purpose and meaning that a lot of business owners have.
Yeah. Well, I appreciate you coming on, John. We got to wrap it up here in the interest of time. So give us some final thoughts, and where can people find more about you?
Yeah. So you can just go to my website, johnmjennings.com, all one word, johnmjennings.com. So it has my blog. So I write a blog called The Interesting Fact of the Day, that I write, a few times a week on just non-financial, hopefully interesting things. So you can subscribe there, find out more about me. You can get a sample copy of a chapter of the book, or you can either go to Amazon or through my website and get a copy of my book, which is called The Uncertainty Solution: How to Invest with Confidence in the Face of the Unknown. And things are going well. It's been super fun writing, and now speaking and promoting my book. Super fun.
Awesome. Well, John, I really appreciate you coming to the show and sharing your wisdom with us. We'll put all that in the show notes for people to go find more about you and your book. But yeah, thanks again for coming on the show.
I enjoyed it. Thanks, Kirk.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with John. Really appreciated him coming on the show. Now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Good day, everyone. Nice to see everyone.
Great. Glad to have you here. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Good to be here.
Glad to have you as well. So, Barb, let's start with you. What are some of the takeaways you got from this interview?
First of all, I think the idea that money does not equal happiness. Yeah, you're probably saying, well, duh, that's like very, very common. But the reality is that if you have money past a certain point, your life really only gets minutely, marginally better. It doesn't make that much difference. So it raises the question of how much is enough, and life, looking at life in a broader context other than just your net worth statement or balance sheet.
Yeah, I think that's a great point, Barb. Phil, what about you? What are some of your takeaways from the interview?
I thought it was a really interesting interview. I enjoyed, though they didn't go as deep as I had hoped, his comments on some of the behavioral aspects. Certainly, he's talking about it in a little different world than a lot of us are, but there's still some good lessons that can be taken from how it is that you get that way.
Okay, cool. So let's start with Barb's, because I think this is always a contentious topic, which is, are the wealthy happier? And there have been some studies, I think it was around 20 years ago, they said if you make 75,000, your money doesn't make you increasingly happy. Now you'd have to adjust that for inflation. So I don't know, what is that, like 500,000 nowadays with inflation? I'm partially joking, but no, I mean, in all seriousness, I mean, there is a certain point where money, I mean, if you think about money, like what's the purpose of money? It's to provide you the things you want. And some people are in an endless bucket. You give them $10 million and they'll spend it all next year. But I think for most of us who realize that, we have a life and we enjoy the life we have, money is a reduction of stress, right? So if I don't have to worry about balance my checkbook at the end of the month, that's a stress I don't have to worry about. I don't have to worry about paying for my kids' college or the mortgage or whatever, losing my job. Those things more or less disappear for people of a certain net worth, but it doesn't mean they don't have problems. And it doesn't mean that they're any happier. It just means that the money problem is somewhat simpler. But on the other way, it's also more complex, right? Because if you're worth $100 million, you've got other problems. You've got taxes, you've got a big one, which people don't talk about, security, right? There's a reason I live in Boston. We're all Yankees here. I hate to use that word because the Red Sox Yankee rivalry, but there's a lot of old Yankees in Boston, and an old Yankee is somebody who has a bit of wealth, but they don't show it. They drive around a beatbox of a car. you know, their house may be nice, but they don't, you know, they might be wearing shabby clothes. Like you look at them and you'd be like, this person's a bum. And we have those all over Beacon Hill. Like when I used to live in Beacon Hill for like 16 years, we had them all over the place. There were people that were just walking around. You think they're homeless, and then they go walking in this huge mansion on Louisburg Square. Like there's a lot of people of extreme wealth in Boston, but you'd never know it because they hide it. It's a very old Yankee thing to do. It's not like it's like old money versus new money. Like new money is all about, hey, look at all the money I got, I'm super rich. And the old money is like, yeah, I'm not telling you how much I got. So it's a very Boston thing to do. But I bring it up because there's a certain aspect of money brings a certain level of joy, and past a certain level, it certainly can make you happy. I mean, you know, if you had a nice house in a beautiful location, make you happy, but at a certain point, there's only so much of that can make you happy, and happiness really comes from within. You know, as long as you get past that certain point. So it's a great point. So Barb, when you think about, you know, money and happiness, how do you think about that aspect? Like how should people be thinking about that for themselves?
Jean Chatzky said something that really touched me in one of her earlier books. And that was regarding the idea of who do you compare yourself to? So most of us compare ourselves to those that are better off than us. And we look at, you know, someone who has more money than us, and we think we're a loser. We don't have enough money. We'd feel better if we had as much money as this person. And unfortunately, today, social media and the filters on your accounts make everyone look better than you, whether they are or not. And if they have more followers, they must be more important than you. She had a tactic that she recommended for people to help them overcome this. I would say it might be a form of FOMO, where you're feeling like you're missing out of people that are wealthier. And that tactic is, don't look at people that are better off than you. Compare yourself to those that are less off. And most of us in this country, even the middle class and poor, have it hugely better than the majority of the world. We have running water. We have indoor plumbing. We have reliable electricity. We have a huge government safety net. And so by shifting your perspective just a tad, you can monumentally increase your satisfaction if you turn your gaze not from looking up so much, but from having a more global perspective and looking at people that really don't have as much as you do. And that's typically most other people in the world.
Yeah, that's a great point, Barb. I appreciate you bringing it up. You know, I mean, FOMO is a big problem. We all do it. We all compare ourselves. You know, if you want to get better, you're looking at, you know, at some successful entrepreneur if you're running your own business, or you're looking at the CEO of your company and be like, oh, how can I have that person's life? And, you know, I think it's human nature to do that. The challenge is when you have FOMO with, you know, friends and peers, and it's all about like, well, they have this and so I want that too. Do you need it? No, but you know, they want it, right? Or like, hey, the Apple's up, or, you know, Nvidia's up 200% or whatever it's up this year. Why am I not in Nvidia? Like, well, because you're not. Like, why are you not in ABC stock that's up 5,000%? Like, I don't know. Like, you know, like, so I think the FOMO aspect is really hard. And, you know, I have a lot of conversations. I have to say this. I have a lot of conversations with like new prospective clients that start with, you know, how can I get a better return? And you look at their situation, they're retiring next year, and it's like, well, you have plenty of money. You don't need a better return. You need something else. So I think people have a misalignment of goals. They're like, I want a better return. Like, actually, what would be better is if you just got like whatever, 4 or 5% a year for the rest of your life. That's all you need. You don't need 500%. You need 4 or 5. So there's like a misalignment of goals and thinking, and a lot of it comes down to FOMO. Like, I should be getting a better return. Like, well, you're all in bonds. Why am I not mimicking the S&P 500? Because you're all in bonds. Like, and I think this is a lot of what you're talking about, Barb, is really important. And if I had to contextualize what you're saying, is you're appreciating what you have and getting perspective for your life makes you happier, and just appreciating what you currently have. And I know this is hard when people are in dire positions, they don't appreciate it. But as you said, we're people in this country are the top 10% in the world when it comes to wealth, even if you're poor. People in lots of parts of the world have nothing. They have less than nothing, and they don't have electricity. They don't have electronics. They don't have wireless. So, I think that perspective brings more balance to life. Comparing yourself to Elon Musk is probably not going to bring you much joy. So.
I just want to chime in. I know Phil has something to say as well, but we have a very, very big unhoused population here in Northern California where I live. And most of those people have cell phones. Most of them have smartphones. So, look, I am not saying that is not a problem, that people don't have housing. I think that is a huge problem and should be one of the priorities of our society to somehow figure out how to remediate that. But it's just pointing out how much we have as a society.
I would also like to point out a definition from Barbapedia. She didn't define the unhoused as homeless, for those of you who don't live in California and are not politically correct.
Oh yes, we are very politically correct here. Thank you for pointing that out. Yes.
Yes, the unhoused.
I don't want to get hit by the, inappropriate speech police that are everywhere here in California.
Yes, they are. That's why I don't live there, Barb. I would be arrested every day. So Phil, what are some of your thoughts on kind of money and happiness point that Barb was making?
So one of the things I want to add on FOMO is this. A lot of times when we're looking at other people and they might have a nicer car or they might have a nicer house, we don't know what the rest of the story is. We don't know how much in debt they are. There's plenty of people that when we have economic trouble, all of a sudden they have to sell their house or they have to do other things to make ends meet. We don't know any of that. We just see them driving this fancy car or see them living in this big house and say, I want that, but we don't know the other side. And it's really important to keep that in mind when you're looking and seeing what other people have. Very different situations. The other thing I want to add to this conversation in general is, so when I work with clients, I go through a life planning process, and there's a big difference in how you go through it with most people and then the very wealthy. Is the first question that I ask in this process basically is, imagine that money wasn't an object and you could live and do what you wanted. What would you do and how would you live your life? Well, when people have a lot of money, you can't add that, right? Because they have the money to do the things they want. So now it's, what would you do if you had more time? What would you do with that time? So there's a big difference that comes between looking at those two groups, right? Because when you're wealthy, you can also do more things to buy time, right? But that's the biggest differentiator a lot of times, is the difference, time and money. Those are two big differentiators to me that you have to take into consideration.
Yeah, it reminds me of this story that I see floating around every once in a while where this, wealthy, it's always a wealthy New Yorker, but a wealthy New Yorker goes down to like Mexico and he goes down and meets a guy sitting on the dock and he's saying, yeah, there's a fisherman. He's like, yeah, you should go buy a boat. Then you can get, you can make more money, and then you can have that more money. You can buy a fleet. And for that fleet, you can create this big company and you could do this, and then you can retire and do nothing. And it's like, I'm already doing it's like, the perspective of like what makes you happy, I think is really important, in that, you can be happy anywhere in life, right? It's appreciating what you have. And I feel like as I've aged, and maybe this is just something that comes with wisdom and age, but I feel like, as I've aged, I've realized like you need a lot less than what you think you need to be happy. Like, and everyone's different. And I'm not saying everybody should be like me, because I know everyone's different. For me, freedom, family, and independence, like just being able to challenge myself, that makes me happy. You know, like I don't need money. I don't need all these things. I need money to do the things that for my family, but like for myself, like I grew up, like my dad never spent any money on himself. And I feel like I'm the same way. Like, I don't, like, what do you need for your birthday? I don't need anything. Just use it for something else. Like, I'm happy with where I am. And I think it doesn't mean I'm not looking to grow and challenge myself and do stuff like that, but like just appreciating where you are in the moment. And I think it's hard for a lot of people, especially when they're struggling. And I feel like in the next 10 years, we're going to have a difficult, challenging economic times, it's already starting to cause a lot of people to struggle. And if you're not seeing this, in the last, I don't know, I have to look up when this podcast is actually coming out from where we're taping it, but I'm seeing a lot of anecdotal evidence of people struggling where you're actually starting to hear about it. So as you guys are talking about, you don't always know what your neighbors are feeling. 2008, early 2000s, all the people you thought were successful, they had like 10 cars, and then now they're the unhoused because they stretched and they thought it would just keep going on forever. And, you know, it's like the government. The government's like, oh, as long as prosperity keeps going, we'll be fine. Like, yes, every successful country in the history of the world has said that. As long as we keep doing this, we'll be fine. And as soon as that growth stops, then everything collapses because it's all based on growth. And I think that we as human beings do that personally as well. Like, oh, I'm going to keep making more money and things will always be fine. And as soon as they're not, just the whole house collapses. There still are people in this country, and I appreciate, you know, when they become clients because they have a good perspective, where they're thinking about things and saying, yeah, like I'm prepared for a year or 2 years worth of unemployment. You know, like, yeah, I know that cash isn't doing me any good, but I'm prepared. Great. Where most of the rest of the population doesn't have more than, $1,000 in the bank, which is crazy. But that's not going to prepare you for being unemployed for a year. So I think it's important, and we'll move on to the next topic, but it's really important just to have a perspective on where you are and to appreciate it so you're not chasing FOMO. FOMO is one of the most dangerous things in finance, which leads me to the next segue into the next section, which is the psychology of investing. So, Barb, when it comes to, psychology investing, what were some of the things you kind of took away from the interview?
Well, I was fascinated by the research that he mentioned about what happens to stocks or investments after you sell them. And what he said was historically they go up. And I was like a little bit in a panic when I was listening to that, because I have a couple of investments that I had sold over the years, and I know they haven't done very well subsequently. And of course, those make me very happy. But then when I look at some of the investments that I had sold over the years, Microsoft, Oracle, some of the big tech companies that I owned at the end of the last millennia, I'm like, that was probably a mistake. So, talking about the psychology of investing, I fall into all the traps. I know them all, but for example, I can't remember what the name of this is. Maybe Phil, you or Kirk, you know the name of it, but it's like treating each dollar differently. It's like the idea of where you spend your dividends and you save your capital gains. There's no difference between dividends or capital gains. It's still the same money. So people that have these all dividend policies, I'm going to only own dividend stocks. Well, look, if you own a stock that has capital growth, you can sell it for cash flow. You don't have to wait for a dividend. So this idea that, and I had an aunt that said to me once, when you get a gift, it's like free money. Well, no, it's not. It's the same money that you already have in the bank account. So if you choose to spend that, that's fine. It's unexpected, but it's the same. Money is not different depending upon where it is.
Yeah, it's fungible. Totally agree. Phil, what about you? What are some of the psychology takeaways you got from the interview?
So first, Barb, I think that was mental accounting. That's what I call what you're talking about, right? We put things in different baskets and think that they're different, but it's all the same. And then to get on the concept you're talking about, the dividends versus capital gains, I mean, that's why we're supposed to look at things from a total return perspective, right? Add up your capital gains plus your dividends. That's your total return. As far as the idea that we all fall victim to these, I was telling the story before, but I'll tell it again. So there's a book by Robert Cialdini called Influence, the Psychology of Persuasion. And then he talks about 6 different tools or techniques that we can use to persuade people. And one of these is scarcity. So I heard Cialdini on a podcast and he tells his story. He goes into the store, he wants to buy a TV. And he looks at this TV, finds one that he likes, and the salesman says to him, if you're interested in that, I would think about buying it because it's the last one we have. And there was somebody that was just here that really expressed an interest in it. So she might come back and get it. And you're not going to get a TV. So he buys it. And then he gets home and he's thinking to himself, I can't believe I did that. I just fell victim to this. I know this. Why did I do that? So he did go back to the store to check and he found that there were no more TVs out. So at least he felt like he hadn't totally been hoodwinked because there were no more. So that's one of the, investors, like the idea that we should be holding things for a long time. I mean, personally, I have stocks that I've held for 25 to 30 years. I believe in long term, but I have made mistakes. Microsoft was one of mine. So I'm with you right there with you, Barb, on that one. But not all stocks are like that. I mean, I can give you examples. Like look at what happened to some of the other stocks. Like look at Cisco in 2000. That stock hit levels that it never has come close to again. Intel did the same thing. You have stocks that they peaked. I think there was a JP Morgan study that talked about the idea that 75 to 80% of stocks, they hit a level that they never get back to. So it's not always a bad decision to sell. What's important is having a process and figuring out when you're going to do that. Another thing that I always like to think about from this behavioral aspect is confirmation bias, right? It's so easy to find people that agree with whatever it is that we believe, whether it's investing, whether it's politics, whether it's anything. And we go out there and seek other people that agree with us. But to me, the best way to do it is find somebody that has the other point of view. Try to understand that. If you're looking at a stock or you're looking at an ETF or a mutual fund, whatever it is, it has a specific strategy or approach that it's taking. Find somebody that takes the other side. Make sure you understand their opinion too, because maybe they're right and maybe you're missing something. But it's so easy for all of us to fall victim to any of these biases, no matter how much we think we know. I mean, I've spoken on this topic, but it doesn't mean that I'm the expert, and it doesn't mean that I can't make the same mistakes as anybody else does, because it's so easy. That's why, these are our behavior, and our behavior isn't always perfect.
Yeah, no, totally agree. Our behavior is rarely perfect, but I think you raise a good point with Cialdini is, understanding a lot of these techniques of what people use to persuade us, helps arm us against it, right? But even if you know it, you still get affected, right? And that's the thing about persuasion is you can know somebody's doing it to you and it will still work. And that's the crazy thing. I had a guy I was talking to years ago and he told me this. He's like, it's like, I could persuade you and you can know I'm doing it and it'll still work. And I was like, nah. So he tried it and I was like, wow. I was like, I feel like I want to do this thing knowing that he's doing it. It's just crazy. But I think that the challenge of our society has gotten such that everyone's doing it, right? Everyone understands. So Cialdini puts out this book and now everybody understands how to do it. And so they're all doing it to each other and it's crazy. And wait till AI, starts to do this. And it gets into this point of it's like an arms race of like, how do you manipulate people better? And, this is like a whole nother level beyond just normal confirmation bias or psychology of investing. This is like a whole nother level beyond that. And it's a little scary to think about it. The new world 10, 20 years from now is going to include technology which understands these principles and can do it to you. That's a little bit scary, but we're not there yet. And I'm not going to worry about tomorrow today. So let's focus on today, which is what other kind of psychological things should we be thinking about when it comes to money, Barb?
Anchoring is a really big one. How many times have you heard an investor talk about a losing investment? And you say, well, why don't you just sell it? I mean, the prospects don't look good. They're closing stores. This company is in a market segment that is declining. So the writing's on the wall. This is not going to bounce back. And the investor goes, I have to wait till I get back to even. Now, that is an anchoring behavior. The stock market doesn't know what price you paid. If an investment's a bad investment, then if you wouldn't buy it today, you shouldn't own it. And this anchoring belief keeps people holding bad investments much longer than they should. You'd be much better off selling a losing investment that you think is very unlikely to recoup and continue its growth trajectory and reinvesting that money in a better prospect.
Yeah, totally agree. Phil, what about you? What's another psychological trick people should be thinking about?
So before I get to that, I just want to add one of my favorite quotes around the idea of anchoring. So Phil Fisher, and so for people who don't know, he wrote a book called Common Stocks and Uncommon Profits, and Buffett attributes his success to the work of, most people associate him with Ben Graham, but it's also Phil Fisher. That's where the qualitative side of investing comes from. And in that book, Fisher has a comment that says, more money has been lost by people holding a stock, waiting for it to get back to even, than almost any other way. Then there's another one that I see so many times, whether it's investing or just in life, is recency bias. That's our tendency to see something happened recently. We look at that and we base our decisions on what just happened instead of looking at the big long-term picture. Like the markets went down last week, so that means we're going back into a bear market because that's what just happened. Doesn't take a look at the bigger picture. This company had a good quarter, good month, good whatever it is, and we want to jump on it because the stock has performed well. But that doesn't mean it's a good long-term investment. It just means that it's done well recently. And we look at what just happened and try to base our decisions so much on on what's recently happened. Recency bias is one that I always think of as something to try to avoid.
Okay, awesome. Well, I want to touch on one more topic before we kind of wrap it up, and that's the idea that John had talked about, which is, when you talk about like the ultra high net worth population, one of the big challenges they have is how do they not ruin the next generation, with money, right? And that's a big problem because if you're worth $1 billion, you never have to work, your kids never have to work. What kind of values are they learning, right? So I think about money as a amplifier for people, right? It's like alcohol is an amplifier for people. Like if you get drunk, it amplifies who you are, right? If you're funny and happy, then that's who you are. If you're an angry person who's, going after everybody, then that's more who you are. So I look at alcohol as an amplifier. Some types of alcohol amplify things more than others, but if you think about money, in some ways, money is an amplifier too. If you're worth $1 billion or if you're worth zero, it will amplify in some ways who you are. So some of the ultra wealthy care about is, are they going to ruin the next generation? Meaning, you think about human beings, like we all go through life, we're workhorses, we have to work, we have to be productive creatures in society, or else we don't have purpose. And so if people are just kind of floating around, not doing anything, what is their purpose, and who are they? And they don't get to go through life and learn all the challenges that we did because they didn't have to, for the most part, just assuming the extreme case. So they worry about that, and they should, right? But most everybody else, so the 99.99% of everybody else who doesn't have to deal with that, they have similar challenges. Like, how do you make sure the next generation is going to be taken care of? Well, just say taken care of, right? It could be psychologically, financially, emotionally, whatever it is. So, Barb, how should most people be thinking about this challenge, right? With your kids, grandkids, like, what should people be thinking about to make sure the next generations are set up properly?
I have two words: Mark Cuban. I don't know if you all have heard Mark Cuban on this subject, but it appears that regularly he talks about how he wants his kids to be productive members of society. And he does not want to indulge his kids. He wants to make sure that his children have the initiative and the interest in working and finding their purpose in being productive members of society. And so that what that means is indulgent parents, no matter if you're wealthy or you're not wealthy, we're all parents here. I think Phil and I are probably have some adult kids, so the date is in. You cannot give your kids everything they want. My husband and I have one child, so we had a unique challenge that at every stage of our lives, we could have spoiled our child because we only had one. We didn't have to divide up, but we made a decision. It doesn't matter what you can afford. Your child has to learn the value of working, cannot be given everything. And also one topic that did not come up in this interview that I think is so important, which is the obligation that we have. And this is my value. I mean, maybe some people don't share it, but I believe if you have been given something, you have an obligation to society to give back. And that should be an inherent part. And I believe that is an inherent part of most successful, well-balanced families.
Yeah, I'd agree. I think that's a great perspective, Barb. And I will actually point out, you said two words, Mark Cuban. They are actually two words. It's not just a name. Mark and then Cuban. They're both actual words. So kudos. But yeah, not to minimize the point, but yeah, totally agree. I think it's a great outlook for a balanced life. What about you, Phil?
So besides echoing what Barb said, I think that it's also important to teach our children about these things so that they have an understanding and knowledge about them of their own. You're right. I do have adult children, and one of them just started his first job, and he's also sort of a client of my firm. And one morning I woke up, logged into Schwab and looked at my platform, and I saw that he had deposited his full year contribution to his Roth IRA. And I just looked and said, yes, because he heard something that I said. And I'm like, I taught him something. I've done my job. So it's important that we educate. And I'll keep it personal again. I have a daughter. She's a senior in high school this year. And we used to complain a lot, my wife and I, because she wanted everything. And you can't give her everything. Now she got a job. So now those things that she wants, she's learning the value of the money because she has to decide if it's something that she wants to spend money on. So again, that's still, it's educating them. It's not indulging them, it's educating them. And sometimes you go a step further, you might have to protect too, right? You can't just say, oh, my child, if something happens to me, the child's going to get everything. Think about when you think they're going to be responsible and try to put it into trust or something like that. So it's protected and it doesn't go to them right away. And I think that over time, the age at which that transfers happen is getting older because people are living longer. I know life expectancy itself has come down some since COVID, but there are, especially when you have more money, people are healthier. They typically live longer lives. So we've been pushing those things out. So I think a lot of it's about educating and having those conversations. And it's something that it's not easy for us. I mean, honestly, as families and as a society, we probably talk more freely about sex than we do about money, but we need to have more conversations about it because that's how you transfer knowledge.
And also let your kids make mistakes. Don't save them from their own mistakes. Let them feel the consequences. I remember when my daughter first had her first bank account and, she racked up some very nice overdraft fees. And I was like, well, now you know what happens if you don't keep track of the balance in your account. You're going to pay the penalty.
Yeah. No, I mean, those are all great points. I'm going to relay a personal story because I find all of this, no matter how well versed you are in finance and how much I do it on a daily basis, it's still a challenge. I mean, one of my kids is, so I should probably bring somebody on the show to talk about this. There's a book called 5 Love Languages, and I don't mean to get touchy-feely, but it's actually a really insightful book. I got it from somebody initially who was very touchy-feely. I almost didn't read it, but I was bored and I had the book there, and I just rifled through the book in like an hour, and it was great. I just devoured it. And the idea is that there's everybody has a one or a combination of love languages. Money is one. I'm sorry, gifts is one. Quality time. I'm trying to remember them all. It's like appreciation, doing like a service for them, and there's and touch. So obviously, if you have employees, you can't use the last one. That'd be a little weird. But if you think about it, like most men, touch is their love language. Like it's just putting your hand on their shoulder. Like that's it meets a need. It's not weird touch, but just physical contact for most men is the priority. Women's a little more complicated. But my youngest is gifts. Gifts is his love language, and that's hard. He's 11, and I'm trying to teach him that to value money. But I know his love language is gifts. And the point of the book is, if you punish the love, so it's like if your love language is touch, and your parent beats you, that's not just a beating, that is like exponential beating, because it's using your love language against you. And it's really interesting in thinking about, so like if your love language is gifts, and I say you can't get any gifts, that's like 10x the punishment. So there's always a balance in here of figuring out, how do you best do this, right? How do I teach him about money, and at the same point not have this perceived as punishment? And so like we've gone back and forth in this, and we went through a big stint when the kids are going back to school, like I want this. So we actually made it into a game where we said, all right, you have X amount of money for back to school stuff. You can spend it all on one thing because you want an Apple Watch. You can spend it all on that, but then you're not going to have any sneakers. You're not going to have any new clothes. You're not going to have a new backpack. Like, you have to make that choice, right? So we put it on him to make that choice, as opposed to us preventing him from getting what he wanted. And then as soon as he got that, he's like, all right, now I want something new. And I was like, okay, well, what do you want to sell? I don't have any more money. Sorry, I'm short of money this month. So he's like, what are you talking about? I'm like, I'm not made of money. Like, I don't have any money left. What do you have? And he's just like, I don't know. So it kind of put it back, and he decided to sell a few things and raise enough money for this other thing. And it was like, great. Okay, now you know the value of money. Like, so the point is you can't just use like a mallet to beat the problem. You have to be more of a surgeon and figure out, like, all right, how are we going to solve the problem creatively, so that you're teaching the lesson, but you're not, because if we don't correct this problem when he's an adult, it's going to be a huge problem. Money, and it's an endless void of trying to fill something that you can't fill, right? You're never going to solve the problem by buying stuff. Now, if he's motivated to work harder for money, great. I'm all for that. But I think any of these challenges we face as people, as parents, as peers, whoever we're helping, you need to have the perspective of okay, how are we going to solve this in a way that's teaching the lesson and not causing a bigger problem? So hopefully other parents can learn from this, because I'm learning every day. But I think it's helpful to hear things like that, because parents have a tough time. It's hard. You try to do the best for your kids, and you don't want to ruin them by giving them too much, and you don't want to ruin them by not giving them anything. So there's this healthy balance of providing love and affection, and also a lesson. And it's hard. Like when my parents raised me, I was raised the same way as my sister. I took it perfectly. My sister did not take it well, because she was kind of wired like my youngest, and it's hard. It's hard. You don't take to certain kind of methodologies, so you're always trying to come up with creative ways, which is why Phil and I are very good at this, because we do this every day with clients. Like, all right, how am I going to get through to this person in a way that they're going to hear me? as opposed to just do this, do this, do this. It's like, no, you're not hearing that. And as Phil said, like he got a client to actually contribute on their own. Like, so it's a psychology battle of like, all right, what can I say? How do I say this in the right way? So I'm educating them and helping them learn, and they do the right thing. And it's not me just yelling at them, you're doing the wrong thing, which never works well, by the way. So, at least in my experience. Anyway, we're going to wrap it up here in the interest of time, but final thoughts from you, Barb.
I think I pretty much said it all. You can find me at Barbara Friedberg, Personal Finance, and on the internet.
Great. Thanks for coming on, Barb. And Phil, final thoughts from you.
So I thought it was a really good conversation. We brought up a lot of really good points. So for me, do you know how stressful it can be when you're experiencing a big life transition? Well, I help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm is Apprise Wealth Management. You can download my free ebook at apprisewealth.com/ebook, and you can also sign up for my blog. Thanks for having me today, Kirk.
Great. Thanks for coming on, Phil. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.